Hey everyone, and welcome to part 2 of our 3-part first home buyer webinar series. Thanks a lot for joining us in webinar 1. We hope you found that valuable. And today we want to get a little bit more into the nitty-gritty of mortgages, what to expect when you actually go through the process, what you need to know about mortgages itself, and also just the generic parts of finance that might be worth you understanding, particularly if you do want to get into the property market for the first time, and hopefully over time, continue to work your way into the property market by eventually getting into property investing or something similar. It might also be valuable when you're looking at doing things like purchasing, your second home or upsizing, just knowing what to look for and what to be prepared for when it comes through to that process. So, probably to get straight into things, looking at what finance lenders look at in particular, and this is just banks, this might be people who you go to for a credit card, all of that sort of stuff where the generic financing principles are kind of taken in place. They tend to look for what's called the 5 C's. Now the 5 C's are almost like the foundation of making a credit decision. They want to understand a lot about what you're looking to do, who you are, and what your situation is before they make a decision. So the 5 C's are character, capacity, capital, collateral, and conditions. So I'll go through each of them in a bit of depth, and then we can obviously kind of review and understand why they are important. So character is the first. Really what a lender wants to know is, who is the borrower? So who are you? Are you the kind of person who is employed? Are you not employed? Are you self-employed? Do you have any debts? Have you had an arrangement before where you have taken a loan? Have you repaid it? Or are you in the process of repaying it? You're not missing payments or running late or anything like that. And getting a bit of an understanding of who you are and who they're lending the money to. So that's the first of the 5 C's, and it gives them a bit of a profile on basically who's going to be paying the loan back. The next C is capacity. So capacity is really your ability to repay the loan. So this is almost strictly related to income. What is your situation to be able to make the regular repayments of having this loan, and how are you going to be able to demonstrate that you can do that when the loan is given to you? So if you earn X amount per month and the loan amount fits within the budget that you've got, or the remaining disposable income that you've got, and you can still live, then often that's enough to demonstrate that you have the capacity to repay the loan. Something to be aware of when it comes to bank lending, and particularly when you're looking at mortgage lending, is the way that the lender looks at these numbers can be very, very different to how you do. I won't get into it too much immediately, but the main difference when you are looking at a mortgage is that banks will often tend to use test rates or stress testing to be able to figure out if you could afford a mortgage. The way they do this is they look at the interest rates that you're being charged if you actually take out a loan, which at the moment are roughly somewhere around 5%, and they will add a margin to that. So many banks might be testing you at the moment at somewhere around, let's say 6.5%, some higher, some lower. And so they add a margin to the interest rate and basically say, hey, look, if interest rates did go up over the course of this mortgage, you might find yourself in a situation where you are paying a rate this high, and so they test you there. So when it comes down to capacity in the 5 C's, and you're looking strictly at mortgage borrowing, the way that the lender might look at your income and outgoings could be quite differently to you. And so that's often where they'll potentially disagree with what they think you can afford versus what you actually could afford, if that makes sense. So again, C is, the second C is capacity, and it really is determined by proving that you can afford the actual loan that you're looking to take out. The next one is capital. So basically what that is any sort of deposit that you've got together. So that could be KiwiSavers, it could be savings, it could be anything like that probably gets you to a position where you have what's known as hurt money in the actual deal, let's say. So if you've got a deposit and you're wanting to buy something that is significantly more than your deposit, the lender doesn't want to be the only one in the transaction and give you all the money, because then it's a lot easier for you to walk away from the loan. But if you had a larger deposit or more capital, then they feel like you're taking some of the risk with them, and you have a lot more to walk away from if you just decide you no longer want the property. So that's where you'll find when you're going through the mortgage application process that banks will only loan to a certain loan to value ratio. So that might be 80% in some cases, it might be 90% in others, it might be 95% in other situations. The portion that they don't lend, that's your capital, and that's the hurt money that you've got to put in to the application, which is usually made up of the the deposit that you save up. The fourth of the 5 C's is collateral, and what that is the property which the banks will use as security for the loan. So if you're buying something for, let's say, $1 million, and you have a $100,000 deposit, you've put in 100 grand, the bank has put in 900, which you're going to pay them back over, let's say, 30 years, but they don't have that money today, and if something were to go wrong, they need something to be able to hold as collateral for the debt that they're giving. The reason why they need that is if something were to go wrong, they had to try and reclaim or recoup their money. The way that they would do that is to sell the property. So if something happened to you and for whatever reason you couldn't or wouldn't pay back the loan, the bank has a first mortgage right over the property, and they will use that as collateral to try and reclaim the debt that they've given to you. The last of the 5 C's is conditions. The conditions are the terms of the finance offer. So what is the purpose of the loan, i.e., helping you buy a house? What's the loan amount that they're willing to give? What interest rate are they going to do it at? What are the terms? So is it going to be a loan that you pay over 30 years, or is it going to be a loan that you pay over 15 years? Understanding those sorts of conditions when it comes to making a finance offer are important, because often different financing arrangements might be required for different types of scenarios. So while a lender might not be able to give you, let's say, a 30-year mortgage in all cases, they might give you a 25-year mortgage as opposed to a 30-year because of your particular situation. So they're still happy to lend, but under a condition that terms are different, or the price is different, or something like that. Another key scenario where this tends to come up is when you have a deposit of less than 20%. One of the conditions they have is that they charge a slightly higher interest rate, which we'll get into a bit later on in the piece. So be aware of the 5 C's. Again, they're like the foundation of finance when someone is looking at actually lending you money, particularly bank lenders or non-bank lenders who are looking at giving you a mortgage, and it really comes down to understanding what those are. So again, it's character, who are you? Capacity, can you afford the loan and prove to a lender that you can? Capital, how much of a deposit you have and how much hurt money you're happy to put into the deal. Collateral, what is the security that the bank's going to lend against? Are they happy with it? Do they like the house? Or is there something wrong with it where maybe they wouldn't lend? And conditions, under what conditions is the lender happy to give you the finance? So it's probably worth leading into another part that's really influencing mortgage borrowing at the moment, which is the Credit Contracts and Consumer Finance Act, or referred to as the CCCFA. A lot of you would have been reading about this in the media lately, particularly over the last 6 months, because it is something that basically came out in terms of regulation roughly around 6 months ago on the 1st of December. Now, basically what happened is that there was an opinion that there were many lenders out there who were lending in a way that was maybe risky for some borrowers, potentially pushing things maybe too far and putting people into positions where they accepted loans that they couldn't afford. So regulation had to come in and try and solve that problem, but what happened, unfortunately, is that the regulation went too far, and that's why you probably would have seen stories in the media where people were being declined home loans over things like buying a few too many coffees or going out to a few too many dinners. These sorts of things in the past is something that lenders would overlook, because common sense suggests that if I'm going to go out and take out a mortgage, I'm probably going to stop spending money as freely as I was prior to having a mortgage, because I don't have the same obligations. And anyone who's going down the process of buying a house, who has saved up a deposit and knows what they're doing and has sacrificed certain things to be able to get there, is probably happy to stop buying as many coffees or going out to as many lunches, or doing the things that they usually would without the same obligations. So it was one of those things that was really frustrating for people in the finance market, and this was for bankers, this was for us as advisors, and even you as clients. It made the whole process a whole lot harder, and it's not something that anyone wanted to come in, not even the banks. It was something that basically regulation made happen, and it went overboard. So a few months later, it basically came out that the government was going to review the proposal that they had actually implemented, and they are going to come up with an announcement on how that might change in June this year. How that looks, we're yet to obviously find out, but the fact that they are reviewing it is a positive thing, because they've had so much negative feedback from people who are involved in the process. Mainly borrowers who are in situations where they know they could afford something, they aren't being given the opportunity to borrow money that they should be able to, simply because of some regulation that has come in. And what we're hoping that the change is that Effectively, lenders will be allowed to look at borrowers and make a decision based on what the borrower is going to do and what they're planning to do, as opposed to what they have done over the last few months. Because no one in their right mind is going to go and live exactly the same way after they've taken on a new mortgage as they were prior to taking on a new mortgage. Fundamentally, people's financial situation changes. They maybe don't have as much disposable income and they're happy to make the sacrifice, and that's why they're going out and buying a house. So assuming that does happen, we're hoping that things will actually go through to being perhaps as easy as they were toward the back end of last year. Not that lending was easy in the first place, so this only made things even harder for people who are already struggling to get on the property ladder. So as and when things progress, we'll be able to announce updates through our different channels and be able to keep people in the loop. But for the moment, it certainly is under review and should make the whole borrowing process a lot easier for people as time moves on. Another thing to be aware of when you are looking at taking out your first mortgage is that in many cases you can have things like credit cards or other types of consumer finance. So consumer finance is things like vehicle loans, personal loans that you may have taken out for a holiday or to consolidate some of your other debt, store cards, gem visas, all of that sort of stuff that people tend to have. Those in some cases can be looked at negatively from a lender. They tend to affect 2 of the 5 C's when it comes down to the 5 C's of credit. One is character and one is capacity. How do they do that? Well, in terms of the first, sometimes what a lender can do if you have too much consumer debt, let's say for example you've got 50 grand in savings but you've got $100,000 of car loans and personal loans and credit card bills, then a lender starts to sit there and go, okay, well, from a character point of view, they're probably looking at someone who spends more than they earn, and they start to question why someone didn't have the discipline to maybe save for some of the things that they wanted, as opposed to going out and racking up a whole lot of debt for it. Now, in some cases, there are legitimate reasons why people are in situations like the one I just mentioned, but other cases there aren't, and lenders want to get an understanding of that when they look to assess whether or not you are suitable to be a borrower. That doesn't mean that automatically they will decline the loan, but it does mean that it can make your journey a little bit more difficult when you are actually going through the process of a loan application, particularly if you go in with less than 20% deposit. So understand that these sorts of things can have an impact on how a lender views you as an individual. In addition to that, if you're looking at the capacity side of the equation, if you're spending a certain amount of your income on repaying consumer debts, then that means you have less income to be able to put towards your mortgage. If you have that situation, then of course your capacity to be able to afford the loan is affected, and what you might be able to borrow could be reduced by having consumer debts. There are sometimes ways around this and ways that you can fix it, potentially by paying these things off or even consolidating them into your mortgage. Again, that's probably something that's a little bit more specialized and worth chatting with your advisor on. Don't always immediately think you have to pay off all these debts to be able to get a mortgage, but in many cases, generally speaking, it makes sense to have less of these sorts of consumer debts because they're at such high interest rates than it does to have more of them. Another key important part is loan to value ratios and getting a bit of an understanding of those. So for the most part, standard lending is done under an 80-20 loan to value ratio. So if you hear people talking about LVRs, that's exactly what it is. It is the value of the loan relative to the value of the property expressed as a ratio. So if I have $1 million property and I have an $800,000 loan, then my loan is 80% of the value of the property, therefore 80% LVR. Where it gets a little bit tricky is understanding the differences in terms of what you might need to be able to purchase a property, and there can sometimes be a little bit of confusion around this concept. So when you go and look at properties, sometimes an agent or a developer might tell you that you only need a 5% deposit or a 10% deposit. But keep in mind that that might be what they need to be able to secure the contract and put you in a position where you are seen as an interested buyer. That doesn't mean that you're going to be able to immediately be in a situation where you can get approved for a 90% loan or a 95% loan. Keep in mind the agent and the developer aren't going to be the ones lending you the money. So what's important to understand is that there are different loan to value ratio thresholds when it's above the 80% mark. So you have 80 to 85, you'll have an 85 to 90%, and then you'll have a 90 to 95%. Different banks are doing different things at different times in this space, and so what you need to be aware of is that who might lend to you might be based not only on your financial position, but also on their availability of funds at the time, and also whether or not you're an existing customer. So to go into a little bit more depth around that part of the process, really probably what you've got to look at the moment is loan to value ratio restrictions that were imposed by the Reserve Bank meant that at the moment most banks can lend only 1 in 10 of all of their loans with an LVR above 80%. So what that means is that they have a lot less credit to lend in the space, and therefore they're stricter on who they lend it to. How that is displayed is by requiring a stronger applicant, or an existing customer, or a combination of both. So a stronger applicant might be someone with a larger income who, after all of the existing and proposed expenses are taken away from that income, the surplus that is left to be able to pay the mortgage might need to be a lot larger than what it would have been in the past when these LVR restrictions weren't as harsh. So that would be what's considered a stronger borrower. Or potentially even someone with a slightly higher deposit. So someone with 85% lending requirement, so a 15% deposit, instead of maybe a 90% lending requirement, someone who has only a 10% deposit. The other flip side of it is banks at the moment are favouring their existing customers. So if you've had a relationship with your bank for, let's say, 3 to 6 months or more, and in many cases for some people this could be years and years, and you have your income direct credited to that bank for a period of time, then in many cases you are what's considered an existing customer. Your bank will often, if they do have the capacity to lend in that above 80% space, your bank will often favour you because you are one of their existing customers, and they might put you before someone who's, let's say, new to the bank. One last part where they tend to make it a bit more favourable is if you've got a live deal on the go. So let's say I'm person A at the moment and I want to go out and buy a house. I don't know what I want to buy, but I just want to get pre-approved for a 90% loan, and then I can go out and start looking. That application might be turned down by a particular bank because it's not what's considered a live deal. However, if you do have a, let's say I'm now person B, I want to go and get pre-approved for a 90% loan, and I know exactly what property I want to buy because it's going to auction, in 2 weeks' time. That might be considered a live deal, and the bank might pick that up because I'm their existing customer and I've got a live deal, for example. So there's different parts to it, and it can often change on a reasonably regular basis. So again, working with a mortgage advisor who is in the market and understands what banks are doing what at a given time will definitely help your situation. Now, again, probably going a little bit more into the different LVR thresholds. So if you're looking at bank lending at the moment, and at the time of us doing this webinar series, most banks are lending up to a maximum of 90% LVR if you are not under a Kāinga or a home loan scheme. So that's the first home loan, which you'll see on their website, and we'll provide some links to that. Now, what that means is that the 90 to 95% threshold is basically reserved for those particular products and people who fit the criteria to be able to fit in that, and there's only about 4 main banks who are doing that. Outside of that, pretty much every bank is happy to lend up to 90%, depending on different scenarios and different credit criteria. In the 80 to 85% space, there is a margin or a fee added to your loan, and it could be up to 0.25%. If you are between the 85 to 90% threshold for the loan to value ratio, then that could be as high as 0.75%. So to get into that a bit deeper, what banks sometimes will do is, if you, let's say half of the banks out there might do a low equity margin, where they'll add either that 0.25 or 0.75% figure to the interest rate that they offer you because of your LVR, or others will charge that as a fee, so a one-off fee, and they're sometimes in some cases happy to add that to the actual loan amount, so you don't have to come up with the money out of your own pocket, but they'll just add it to the loan. Why do banks do that? Banks do that because the fact that the application itself is deemed more risky, and so they charge a higher financing rate by doing it, and that could be either fees or interest. The one thing to consider is, in those sorts of scenarios, if you have extra cash and are able to get from, let's say, 86% down to 85%, then you might be in a position where you save yourself 0.5% margin or 0.5% fee. and working through that might be something that you would discuss with your mortgage advisor if you are on the line of basically figuring out what's best for you. So looking at those sort of LVR thresholds might determine what you do and don't put into the property, depending on how much savings you've got. And it also might attribute to what sort of interest rates that you are actually offered, depending on the bank that you are with. Whether you go for the fee option or the margin option will very much depend on your plans with the property, and also, for example, how long you plan to stay in the property and repay down your debt, or how long you are in a position where you might want to renovate the property and things like that. So just understanding that and the intricacies of that might determine whether you go for a margin option or a fee option, and what bank might be suitable for you. So having an above 80% loan can sometimes be quite complex. It can also be quite expensive in some cases, but many times it's the only option for many borrowers out there. So it is something that banks are happy to do, but simply because of the restrictions placed on them by the Reserve Bank at the moment, it means they are more limited to doing that than what they would have otherwise been in the past. Banks very much are in favour of wanting to lend in this space, as I mentioned, particularly for existing customers at the moment, but we're very much seeing this sort of application on a regular basis right now. The above 90% space, as I said, is very, very limited at the moment, and most banks are out of that space unless you are a first home loan client or a customer. Where you can find more information about that really will be based on what is available to you under particular thresholds. For the most part, those are income thresholds and also property price thresholds, so how much you earn and what the value of the property is. So to get a little bit more into that at the moment, getting an understanding of the first home grants and also these first home loans is going to be important if this is something that is suitable for you. So broadly speaking, there are 4 main banks and there are also some other lenders who actually lend in this space. If focusing on the banks at the moment, it is Westpac, the Cooperative Bank, Kiwi Bank and SBS. So 3 of those 4 are New Zealand banks, and obviously Westpac, which is an Australian bank but obviously has a presence here as well. So that means immediately, if you are in a situation where you're going out into the mortgage market and you want to be in a situation where you have one of these first home loans, the amount of lenders that you have access to has halved, because you have significantly less banks who are actually operating within this space and doing this product. What you need to be aware of is it really comes down to things like your income and also the price in which you are willing to pay for a house. Now, the same criteria applies for the grant as it does for the first home loan. So the income side of things is it's going to be $95,000 before tax per annum for someone who is an individual with no dependents, and $150,000 in one of the following 2 scenarios. Either you are an individual with 1 or more dependents, or you are a couple with no dependents. So those income caps are a lot better than the ones in the past, and they actually provide a lot more loan options than what you could previously get. Prior to the changes in these caps, we often found that the idea behind the Kaienga product was great, but when it came down to actually assessing a loan application for, let's say, someone who was an individual, they couldn't meet the upper end of the house price caps, and so they were stuck because the bank wouldn't loan someone with that income that amount of money. So I think what's happened is that there's been enough communication about this, and basically some of the rules have been changed and those income price caps have been increased to be more aligned with what banks are willing to lend to people of that income. The second part of it is the house price caps, and understanding where your region is on the different types of caps out there. There are many different house price caps, and there's also a difference in most cases for new and existing properties. So if you're buying a new build versus if you're buying an existing property, sometimes the house price cap in a given region can be different. In Auckland, they're the same. It's 875 grand, which is a lot higher than it used to be not too long ago. So that's a huge positive. The highest, I believe, for an existing property anywhere in the country is 875, but there are some areas like some parts of Wellington and also parts of, for example, Queenstown and other parts of the country where you can get up to 925k for a new build property as the house price cap. Where that's important is if you do have, let's say, a 5% deposit and you are able to meet the income criteria to get a 95% loan, then in many cases you're able to now buy a property for a lot more than you were able to in the past by having a lower deposit. In the past, if you had a lower house price cap, like let's say 700 grand, then a lot of people might have had their 5% deposit and they might have met the income requirements, but they're in a situation where they can't buy any houses because they are excluded from everything over and above a certain figure. And so a lot of people felt like, again, the idea was great, but it didn't actually work out in reality because they couldn't find a house suitable for their situation. So these recent changes that have happened in the Kāinga Ora space are fantastic, and tying that back to the first home grant side of things, if you are an individual, you might be eligible for up to $5,000 for an existing property or $10,000 for a new property. If you are a couple, then those numbers could be doubled. Again, it's going to come down to meeting a few different pieces of criteria, things like how long you've had your KiwiSaver and how long you've been contributing to it, meeting those house price and income caps as well, and then fitting that all together with a bank that is happy to lend to you in your particular situation would allow you to potentially end up with $20,000 more of a deposit and also some basically preferential treatment on some of the interest rates that are offered to you in that first home loan space. So if you want a bit more information about that and want to get an understanding on whether that might be possible for you, that's where you have to get in touch with a mortgage advisor who works with people in this first home loan space. Again, alluding back to what I mentioned in part 1 of this series, you want to get your solicitor involved in this process too, as they'll very much be someone who will help you through the process of understanding whether or not you're eligible for this first home grant and being able to get you in a position where you can actually release that. Something else to be aware of, which people often tend to forget when they are looking at purchasing their first property, is budgeting for the extra costs that might be applicable. As I alluded to earlier, you might have costs during the process, which are things like building reports, valuations, that sort of stuff. But then also when it comes to actually moving or finishing things off, you'll have your legal bill, you'll have moving costs. It might be things like actually hiring movers, or anything like that which could be applicable or extra over and above the budget that you've got. If you're in a situation where, let's say for example, you have only enough to meet your deposit, then you might want to consider buying a house for a slightly lower price so that when you move, you still have basically enough money to continue you through until, let's say, your next pay cycle, and have a little bit of buffer in case something does go wrong. There could be some unexpected maintenance with the property, or it could be something completely unrelated to the property where life just simply happens and something goes wrong, and you want to have a bit of a buffer or a bit of a savings set aside for part of that process. Alternatively, it might just be things like new furniture, new things that you want to add to the house, or little renovations that you want to do. So you want to budget and factor all of that sort of stuff in as well. Banks will often tend to give you cash contributions, which can be really, really helpful for this process. And basically what that would mean is that they would give you a particular amount of money, usually a few $1,000s, and that set of funds would be deposited into your bank account, but only after the settlement. So often within 48 hours of the loan being settled. The reason banks do that is it's a gesture of goodwill for your business. It's to help you cover the legal bills and any other moving costs that you've got, and hopefully help make the process a little bit easier for you. So while that can go towards having the extra reserve or buffer for the extra costs that you might incur, you'll still want to factor that sort of stuff in and make sure that you're not left in a situation where you have nothing left. One other final thing to consider when it comes down to understanding the mortgage process or financing is being aware that there are many, many different types of mortgages, and the way that you structure things can vary quite dramatically. For the most part, if you are a first home buyer and you're buying a property that you're going to live in, then you're probably likely to be paying both principal and interest on the mortgage that you've got. Basically what that means is you're not only paying the interest costs for the mortgage, but it also means that each payment that you make reduces the total balance of your loan. There is an option for mortgages to be on interest only, but that won't be applicable for this particular webinar. However, if you look at some of our content, we do have plenty of information around interest-only mortgages floating around. So if looking at the fact that your mortgage is very, very likely to be on a principal and interest basis, that's not all there is to consider. There are other things like whether your mortgage is going to be fixed or floating, and also getting a bit of an understanding of different products out there, such as revolving credits or offset facilities, and knowing what those are and how they might benefit you. So we will have an info sheet which we can include as part of this webinar, which we can link through to you so you get an understanding of each individual product. But going through them to give you a bit of an understanding, let's start with fixed rates. With fixed rates, what you have is an option to make a contract with the bank where the interest that you pay stays the same for the duration of the contract. Those fixed term options can be anywhere between a 6-month loan right up to a 5-year loan, fixed term. So your payments could stay the same for any duration between that. So the options with most major banks at the moment are 6 months, 12 months or 1 year, 18 months, 2 years, 3 years, 4 years, 5 years. So quite a few different options out there, and what you pick will very much be determined by your goals and also what the pricing is at the time. So the reason people tend to pick longer fixed rates will be because they either are very, very much in favor of certainty, or they are expecting interest rates to go up in the near future, for example, the interest rate market that we have at the moment, or a combination of both. So they might appreciate the certainty, they might think, I might as well lock in a good rate now because in the future, in the short term, I don't think I could get a rate as good as this. And so they're in a situation where they go, okay, I'm better off to take what I've got now and have the certainty and be happy with it. Those people usually stay in their properties for an extended period of time. They're not going to be moving house in the near future, or at least don't plan to. And so they're happy to lock in for, let's say, 3, 4, 5 years and basically set and forget their mortgage. The alternative option is, of course, a floating mortgage. Floating mortgages are different and in many cases can have a slightly higher interest rate than a fixed rate. However, the benefit of a floating mortgage is that there is complete flexibility. If you want to lump sum repay your mortgage, if you want to add any regular additional extra payments, you have quite a few options there in terms of what you can do with the mortgage and when you want to make your payments. So you'll still have a regular minimum payment with both options, but when it comes to a floating mortgage, you have a lot more flexibility around making ad hoc payments, which can be very, very valuable for people who maybe receive bonuses, commissions, or even who are self-employed. And so having that flexibility can be really, really useful. Now, that doesn't mean that with the fixed mortgages themselves, there is no flexibility at all. Different banks have a few different options where you might be able to pay, for example, an extra 20% of your regular repayment amount as an extra payment without incurring penalties, or an extra $1,000 a month, or $500 a fortnight, or even some banks allow you to do 5% of the balance of the loan per annum without any penalties. So there's various different products out there and different options depending on the bank that you can make additional payments within a fixed rate mortgage contract and still have the option to be able to pay down your debt more than you maybe had originally anticipated that you could when you actually fix the mortgage. So understanding those sorts of products will be valuable for you when you try and figure out which bank might be most suitable, and also what your plans are for the coming years ahead. Now, to get into something else which can be a little bit more complicated is to get into revolving credits and offset facilities. Now, both of these are on a floating mortgage rate, so as mortgage rates continue to, let's say, go up and down, so does the rate that you are being charged on your revolving credit or offset facility. Where these facilities are different is if I start with revolving credits, imagine it is like a giant overdraft facility. So basically you'll have a limit. So let's say I take out a mortgage of $1 million and I want to put $50,000 of that on a revolving credit. The limit will remain the same at $50,000, but if I want to throw any cash that I've got in there, maybe any extra savings, or as I said, let's say I've got bonuses or commissions or self-employed income where my income can often go like this, I might put my money into that facility. The great thing about revolving credits like overdrafts is that you don't pay interest on the $50,000 limit, you only pay interest on the balance owing. So if, let's say, I have $40,000 of savings in my revolving credit, then the only amount that I have owing is $10,000, which means that basically I'm in a position where I'm paying the floating interest rate on $10,000 rather than on $50,000. That's really beneficial because interest is calculated on a daily basis. So if the balance of your mortgage is a lot lower for most of the days out of the month, then your interest cost will be a lot lower. over the course of a mortgage, that can save you significant amounts of interest, which of course can mean that it can cut a significant amount of years off the mortgage that you actually have. So instead of paying it off over, let's say 30 years, you might pay it off over 25 or 22 simply by following little tricks like that. An offset facility is very similar, but instead of having one account, which a revolving credit is, with just a big limit, an offset account can be 2 or more accounts. One of the accounts is a loan, and the other, or the others, are savings accounts or check accounts or anything with other money in them. The sum total of all of the funds that you have in the accounts that are linked to the loan account will offset the mortgage. So let's say you've got a $100,000 offset loan account, and you've got a check account with $1,000 in it, you've got savings with $10,000 in it, and then you've got another account which, let's say it's your tax account if you're self-employed, and that might have $20,000 in it. All up across the three, you've got $31,000 offsetting the $100,000 mortgage that you've got, so you're only paying interest on the difference, which is $69,000. So in that scenario, sometimes people like to separate their accounts to keep things clean and easier in their head. Basically, it means that they're still getting the benefit of being able to offset their mortgage, but it means that they can still compartmentalize all of their different accounts for the different things that they have going on in their lives, whether it be day-to-day bills, savings, or anything else that people do work through. So understanding those sorts of products can be really valuable when you are in a situation where you're trying to figure out what might be the best structure for you. So again, to go through some of the different options out there, there's fixed rates, which gives you a whole lot of certainty. There's floating mortgages, which can be slightly more expensive, but often give you a whole lot of flexibility with not much certainty. And then there's revolving credit or offset options, which allow you to use any of your additional cash that you don't want to lose access to and still be able to take back out to offset your mortgage and reduce your mortgage interest costs. So have a discussion with an advisor and work through that process to figure out what might be best for you based on your goals. So again, just to probably have a bit of a wrap up and overview, when applying for a mortgage or going through the mortgage process, it's worth understanding what the lenders are looking at, because that can help you to make sure that you're doing the right things prior to actually going through a mortgage application. Banks are definitely tougher than they used to be, particularly because of things like the triple CFA. And so making sure that things are as clean as possible when you go through the process of actually applying is going to be one of the key things that helps you have a smooth application process and a better chance of getting approved. Another piece is that consumer debt is definitely not the be-all and end-all when it comes to mortgage applications, but it is something to consider. If you have too much of it, it might not look too good, and you want to be in a situation where you put your best foot forward when you do apply to a lender. So having a chat with an advisor on how you may be viewed as a result of your consumer debt prior to formally applying to a bank would be a really, really good thing to do. Loan to value ratios can also determine a lot about how a bank views your application. It can be how strict they are or how harsh they are when assessing things, but it can also determine how they actually price your loan, whether it be by higher interest rates or additional fees. In addition to that, you want to be able to look at understanding if a kāinga or a product might be more suitable for you. It could be that you are in a situation where, let's say, you have a lower deposit, or even if you are in a situation where you meet the criteria to be able to get one of the grants, you're better off to try and take that money if you are eligible, because it's free money and it's something that you can be basically be in a situation where it helps you a whole lot more because you have so much more of a deposit, potentially up to $20,000 more. Lastly, understanding different types of mortgages, of course, can be the difference between how much interest you pay over the life of the loan. Not all loans are the same, and neither are all borrowers. So what you actually end up taking out for your particular situation could have a dramatic difference in terms of how long it takes you to repay your debt and how much interest you're charged. Working with an expert who knows exactly what might be best for your situation will help you figure this out and also make sure that you reach your financial goals a whole lot quicker. So thanks so much for paying attention to part 2. We definitely will have part 3. We've got a few guests coming on to work with you guys. And if you've got any questions along the way, as always, please feel free to get in touch with us here at Chris Peterson Mortgages. Thanks.